Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll start with preparation of stock ledger under two different methods, FIFO and weighted average basis. Stock registers are maintained by the manufacturers to have material cost control. In every organization, different systems are adopted to keep record of receipts as well as issues of stock so that there can be proper control on material cost. Under manual system, there is system of preparation of stock register where manually we record receipts and issues of stock. Now people have started using computers, so through softwares we are recording issues and receipts of stocks, and that we are same principle we are maintaining. From the following particulars, prepare stock record by FIFO and weighted average method. 4 January 2014, there is purchase, so this will be recorded as receipts of 40 units at the rate of 30. On 17 January again there is purchase, so receipt 60 units at the rate of 28. On 20th January there is sale of 50 units at the rate of 35. This will be recorded as issue. 22nd January purchase of 80 units at the rate of 29. This will be recorded as receipt. On 25th January there is a sale of 80 units at the rate of 33. It will be recorded as issues. On 28th of January there is again a sale of 20 units at the rate of 34. This will be recorded as issues. On 30th January there is a purchase of 100 units at the rate of 26. This will be recorded as receipts. On 31st January there is a sale of 90 units at the rate of 35. This will be recorded as issues. The stock on hand on 1st January 2014 was 50 units at the rate of 25 each. This is the information of opening stock. So we have gone through the question. Let us prepare now stock ledger under FIFO method. What is FIFO method? That is first in, first out. That is a full form of FIFO. That means stock which is received first will be issued first. This method is used particularly in case of short life products or perishable products which we cannot store for a longer period. Therefore the old stock is issued first and closing stock we get from the current production or current purchases, because fresh purchases will be maintained in closing stock. That method is called as what? First in, first out. So we have prepared stock register having columns date, receipts, purchases, issues, sales and balance column. There are three sub columns: quantity, rate, amount. Quantity, rate, amount. Quantity, rate, amount. First we are required to record opening balance as on 1st January 2014, 50 units at the rate of 25 each. Date will be recorded here in date column. 2014 January 1st. Opening balance will be recorded here. Quantity 50 units. Rate is given 25 each. So it will be 50 multiplied by 25, 1250. On 4th January 2014, there is purchase of 40 units at the rate of 30. Date column will be putting the date 4th January. Purchase of 40 units will be putting in quantity column, rate 30. So amount is 1200. Now we are required to record balance of stock. Previous stock opening balance will be recorded here first. 50 units at the rate of 25, 1250. Fresh purchase of stock will be added here. 40 units at the rate of 30, 1200. So we have now two stocks, 50 units and 40 units. On 17th of January, again there is a purchase of 60 units at the rate of 28. In quantity columns we have entered 60 units, rate is given 28. So value is 1680. Now we will be recording closing balance. First we have to take oldest stock 50 units at the rate of 25, 1250. Next 40 units at the rate of 30, 1200. And now current purchases 60 units at the rate of 28, 1680. So we have now three stocks, 50 units, 40 units and 60 units. On 20th January, there is a sale of 50 units at the rate of 35. Even though selling price is given, we are required to ignore selling price and we are required to record issues at cost. So there is sale of 50 units. In date column, we will be putting the date 20th January. There is sale of in all 50 units. So we will be issuing from the oldest stock 50 units at the rate of 25, 1250. Now balance stock will be 40 units at the rate of 30, 1200. 60 units at the rate of 28, 1680. So these are the two stocks in balance. On 22nd, there is purchase of 80 units at the rate of 29. Date 22nd, purchase of 80 units at the rate of 29. So it will be 2320. We will be recording now closing balance 40 units at the rate of 30, 1200. 60 units at the rate of 28, 1680. And now fresh purchase 80 units at the rate of 29, 2320. On 25th of January, there is a sale of 80 units at the rate of 33. But selling price has to be ignored. We are required to record issues at cost. In date column, we will be putting the date 25th of January. There is issue of 80 units. So first we will be selecting the oldest stock 40 units at the rate of 30, 1200. Total issue is 80 units. 40 units we have selected here. 40 more units will be selected from the next stock, that is 60 units. 40 units at the rate of 28. So it will be 1120. Now out of these 60 units, we have issued 40 units. So balance units are 20. Rate is 28. It will be 560. Next 80 units at the rate of 29, 2320. So we have now two stocks, 20 units and 80 units. On 28th, there is sale of 20 units at the rate of 34. We have to ignore selling price 34. We are required to record issues at cost. In date column, we will be putting the date 28th. There is issue of 20 units. We have two stocks, 20 and 80. So it will be issued from the oldest stock, 20 units at the rate of 28. So balance will be 80 units at the rate of 29, 2320. On 30th January, there is purchase of 100 units at the rate of 26. In quantity column, we have entered 100 units, rate 26, so it will be 2600. There are no issues. Balance we are required to record. Old stock will be recording first, 80 units at the rate of 29, 2320, plus fresh purchase 100 units at the rate of 26, 2600. On 31st of January, there is a sale of 90 units at selling price 35. So of 90 units, first we will be issuing 80 units of oldest stock at the rate of 29, 2320. Out of 90, 80 units we have taken from here, 10 units will be taking from the next lot. 10 units at the rate of 26. So it will be 260. Out of 100 units, 10 units are issued. So balance stock will be 90 units at the rate of 26. So it will be 2340 rupees. So we have recorded all transactions which are given for the month. Now we can arrive at figure of closing stock. Here closing stock is valued at 2340. This is as per FIFO method. Now we are required to find out closing stock as per weighted average basis. We'll solve as per now weighted average basis. Opening stock on 1st January, 50 units at the rate of 25 each. We'll be putting the date 2014, January 1st. Opening balance 50 units at the rate of 25 each. So it will be 1250. On 4th January, there is purchase of 40 units at the rate of 30. So amount will be 1200. Now under weighted average basis, we don't have a stock which we can identify as a old stock and new stock. In case of oil, water, chemicals, they are stored in big tank. So old stock and new purchases gets mixed, and they get mixed in such a way that they cannot be separated. So we cannot have principle of FIFO. Therefore in this case we are valuing stock on average basis, weighted average basis. Now how weighted average basis works? We are having now existing opening balance 50 units. Fresh we have purchased 40 units. This 50 and 40 units will be added. So total units are now 90 units. 50 units we are having total value 1250. Fresh stock which we have purchased is having value 1200. These values will be added, 1250 plus 1200. It is 2450. Now 2450 will be divided by 90 to arrive at weighted average price. It is rupees 27.22 paise. That is the weighted average price. On 17th January, there is purchase of 60 units at the rate of 28. It will be 1680. Now existing stock we have 90 units. fresh purchase is 60 units. So 90 plus 60. So it will be 150 units. Value is 2450 plus 1680. Total units are 150 and value is 4130. Now 4130 will be divided by 150 units to arrive at weighted average price. It is rupees 27.53 paise. On 20th January there is a sale of 50 units at the rate of 35. We are required to ignore selling price 35. We are required to record issue 50 units at cost price. In quantity column we have recorded 50 units. Rate will be taking this 27 rupees 53 paise. So it is rounded off to 1377. Out of 150 units, 50 units are issued. So balance will be now 100 units. Valued at 27 rupees 53 paise. 2753. On 22nd January there is purchase of 80 units at the rate of 29. So purchase cost is 2320. Now we are required to record stock. We are having 100 units. To these 100 units, these 80 units will be added. So total number of units are 180. Existing stock is having value 2753. To this we will be adding 2320. So it is 5073. This will be divided by 180 to arrive at weighted average price 28 rupees 18 paise. On 25th there is a sale of 80 units at the rate of 33. We are required to ignore selling price. We will be issuing units at cost. Issue of 80 units, rate will be 28 rupees 18 paise. Out of 180 units, 80 units are issued. So balance units are 100 units at the rate of 28 rupees 18 paise. 2818. On 20th January there is sale of 20 units. Rate will be taken 28 rupees 18 paise. It will be approximately rounded off to 564 rupees. Out of 100, 20 units are issued. So balance units are 80. Rate is 28 rupees 18 paise. 2254 rupees. On 30th January there is again purchase of 100 units at the rate of 26. 100 units purchase at the rate of 26. So it is 2600. Now we are required to record closing balance 80 units plus 100 units. It will be 180 units. Value 2254 plus 2600. It is 4854. So it is 26 rupees 97 paise. On 31st January there is a sale of 90 units at the rate of 26 rupees 97 paise. 26 rupees 97 paise. So it is 2427 rupees. Out of 180, 90 units are issued. So balance is 90 units. Rate is 26 rupees 97 paise. So closing stock will be 2427. We have recorded all transactions Now as per weighted average basis, our closing stock is ₹2,427. As per FIFO, it was 2,340. As per weighted average basis, it is 2,427. So there is difference in closing stock due to difference in application of method of valuing stock. This is what we have learned in this question. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.